Hello friends, welcome to your own channel Noiseless Investment. Here we decode a company based on the fundamental analysis and get to know if the company is worth our investment or not. Please note I am not a SEBI registered advisor and these are my personal views based on the fundamental of this stock. This video is for the educational purposes only. Please do your due diligence before investing. Please like this video, subscribe to my channel and click on the bell icon to get the useful information on a regular basis. The main purpose of this video is to mute the noise the operators create and as a result the gullible retail investors fall prey to. The purpose is to beat the operator by our own acquired knowledge. So here we are going to decode KRBL. Now if we look into the KRBL, so this is the site for this company, and if we go into the fundamental analysis of the company, if we see that the current market price of KRBL is 348 and the current market cap is 8,201 crores, and the ROC for the company, the return on capital employed is 20.9, ROE is 16.0, and for the last 3 years the average ROCE for 3 years is 18.7, average ROCE for 3 years is 14.7, average ROCE for 5 years is 19.5, and average ROE for 5 years is 16.2. So all in all the company is actually maintaining a good ROCE and ROE for the last 10 years. Now, if we look into the promoters holding, then we see that the promoters is holding 60% shares in this. The FIIs are holding 4.68% and DIIs are holding 0.06%. And the change in FIIs holding is minus I mean they have reduced the stake by 0.26%, and DIIs they have increased their stake. Now, if we look into the profit growth, that is and the sales growth, that is the CAGR of this company. So the company operates on a CAGR of 27.4% sales wise and 52.7% profit growth by CAGR. And if we look into the sales growth for 3 years, it is 6.03%, and the sales growth for 10 years is 5 years is 10.6. Similarly, the profit growth has been 7.89% for I mean the average profit growth has been 7.89%, and profit growth has been 10%. If we look into the operating profit margin, so the company operates on a profit margin of 17.5%, which is like out of 100 rupees the company is generating, so the takeaway for that company is 17.5 rupees, so which is impressive. Now if we look into the whether the company is debt free or not, so the company is having a very minute debt on itself, which is 0.05%, which is far less than the other companies. And if we look into the interest coverage ratio, it is 64.8, which is good, which is very good. And if we look into the current ratio, 6.35. So the company is having enough surplus in its account. Now, if we look into the intrinsic value for this, the intrinsic value is coming out to be 447, and the PEG ratio is 1.17. The company still have chances of its growth, so the company can grow in future. And however, the PEG ratio should be less than 1, but for many companies, if you will see, it is 5, 4, 6. So they have already grown up companies, so that is why the PEG ratio for those company comes out to be bigger. So here it has got some growth chances as well. Now if we look into the reserves of the company, it is 4669, which is good. And if we look into the Petrosky score, which actually tells you about the financials of the company, which is also good. And if we look into the return over 1 month, so the stock has set itself by 15%, and over a week it has set by around 4.65%, and return over 1 day has been 1.23%, which is The company has not performed well over 1 month, but today the company was showing some strength. Now, coming back on, so we have looked into one side. Now we look into the other part of this. So if we look into Investing Pro, um investing.com, then we find that the fair values of KRBL is coming out to be 506. So an upside of 45.1% can be there. And if we look into the revenue, so these are the pros and cons of the company that is listed here. If we look, so we find that revenue growth for this has been accelerating, which is good. Yields, high returns on invested capitals, which is also very good. But poor earning and cash flow may force dividend cuts. So there will be some dividends which they may cut because of some uh, cash flow issues. The cash flow is not very good this year, and trading at low PE relative to the near-term earning growth, prominent player in the food product industry. So they are into business since a very long time. Like if we look into their website, then we find that uh, the company is into operations since 1889. So initially the company was started in Lailpur, Pakistan. Then it moved to India, and then it moves to move to Delhi, and thereafter all these things they actually achieved in this years. So we can rely on this company, as the company is more than 100 years old. So we can put some faith here. So rest these fair value is based on 14 models that is described here. So earning power values is 242, price book value is 458. You can go through this thing, and the average of all these models is coming out to be 506. So and the upside potential is coming out to be 45.1%. So this you can consider that it is a 1 year range, so it can be a 52-week range for the upside to happen. Thank you so much for watching this video, and please like the video, subscribe to my channel, and click on the bell icon to get the useful information on a regular basis. Thank you so much.